You've heard about infinite banking so much, it sounds so amazing. It promises this revolutionary approach to grow your wealth, but is it too good to be true? In this video, I'm gonna actually dissect this concept, separating fact from fiction, so you can make an informed decision about its role in your financial plan. Okay, first and foremost, whole life insurance has been used for centuries, literally. If you go back to the history of life insurance, people actually use a version of whole life. Now, it may not have had the cash value component. Some people just had group term, so to speak, right? But whole life, even in its current form, has been used for at least a couple centuries. You know, it's been started here even after the Revolutionary War. There was life insurance companies starting to do whole life insurance, right? Where you can actually build up some cash inside of it, having a death benefit where you have an even payment for the rest of your life. That's been around for a long, long time. Now, infinite banking, separate that from whole life insurance, is different, right? But I'll tell you, even the infinite banking strategy has been used for at least, for my knowledge, minimum decades, if not at least about 100 years. Okay, there have been people using this whole life cash value for other things in their lives. For example, JCPenney's during the Great Depression, which was about 100 years ago. During the Great Depression, JCPenney's was paying their payroll just so they can keep the company afloat. They were tapping into their own policies. Even Walt Disney, when he built Disney World, he actually tapped into his life insurance. He had to use that as collateral so that the banks would come in with the rest of the money to help him buy the property in Orlando. All these things that you hear about, even Ray Kroc, when he bought McDonald's, was using his life insurance policy to help pay for his executives. This has been done for decades. Banks have been using this for decades. They have what's called BOLI, bank-owned life insurance. Banks often will have a large percentage of their portfolio invested inside of life insurance, using these kind of policies themselves. They'll get on their bank executives or whoever they can get it on and store their cash in there. Why? Because they know it's a safe place to store their cash and it gives them a greater ability to lend and create more money. They can arbitrage the money that's in those policies. So that's the great thing, guys, is that banks have been using it for decades, if not centuries. We've also had entrepreneurs and people using it for a long time. So it's not that it doesn't exist or this is a new latest trend. This trend has been around a long, long time. It's just now starting to become more popular among us, among normal people. Now, I will say this, beware of half-truths that you hear about infinite banking, right? There are so many times I hear videos from these other infinite bankers. Again, they're good guys and women, of course, but sometimes they try to sell it and spin it in a way where it sounds like there's only positives and no negatives. Now you might say, well, Chris, it sounds pretty overly positive when I hear your channel. Well, that's true because we address the negatives to make it turn into a positive, if that makes sense. And the truth is, I don't like to give half-truths. I like to say, here's exactly what happens. You decide if it's good. So for example, when they say pay yourself interest, you'll hear people say that all the time. Yeah, you borrow from it and then you pay yourself back the interest. No, you do not pay yourself back interest. That is false, 100%. Here's the truth. What happens is the insurance company is paying you interest on your money in there, but you're not pulling money out of there. You're not borrowing it by pulling money away from that so that the balance drops. Your money's still there. What you're doing instead, you're getting from another pocket, from the insurance company. They're giving you their money at an interest rate, and then you can use that money for whatever you want. Whether you're, buying, houses, whether you're buying cars, whether you're investing it, blowing it, whatever. When you pull that money out, you're paying them, the insurance company or a bank, interest. Your money's still in there earning interest. So people say, just to save that little explanation, I'll just say you pay yourself back interest. Or they'll say things like, when you pay it back to the insurance company, pay it back like you're paying a monthly payment to the bank, but you pay it back to your bank is what they'll say. But really you are paying it back to them. They act as the bank. So the truth is, you're still borrowing money, right? But this is why it works, because your money is in here still growing, compound interest, tax-free. You're essentially able to earn more money than what you pay them. That's called, in banking terms, arbitrage, right? Where you earn more interest than you pay for it, you make money. That's a no-brainer. People do that all the time investing. They want to arbitrage it, right? They want to be able to make more in interest. Be careful. Sometimes that interest could be higher depending on how you do it. But if you pay it back the way they teach, then yes, you will still earn more interest than what they charge you. But make no mistake, you are paying interest. So when they say pay yourself interest, that is false. That is not the case. Also, another thing you hear a lot of times, people say, oh, you buy your cars with this, you buy your houses. Even recently, I've had people ask that question. I say, no, don't. Now, it doesn't mean that it doesn't always work that way, but sometimes it doesn't work that way. It shouldn't work that way. So for example, when car loans were at 3%, people would say, oh, well, I'm going to use my infinite banking policy that has a 5% loan to buy my car. But again, they're thinking they're just paying themselves interest, so it's fine. I was like, no, it's not that you have zero interest here. You're still paying interest to the insurance company. Instead, borrow from the bank. In fact, this is my mantra. I like to borrow cheap money from the bank whenever I can. Get money from the bank because it's not my money, right? I'm borrowing their money. Now, again, I believe I'm a wise steward of that money. I know what I'm doing with it. I don't recommend everybody just pull out all the cash and then gamble their money away, right? I use it to buy assets like cash flowing investments. But when I'm borrowing money to buy that car, I know I'm paying cheap money for that money. I'm not going to use my policy for that. I'm going to let my policy earn more interest, and then actually I'll go and invest it, making higher interest on that money versus just trying to save myself the 3% while paying 5%. So that's the thing, guys, is that if I use my insurance policy, say it's at 5 or 6% loan rate, and it's a 4% loan rate at the bank, I'm gonna go for the bank every time. Heck, even if they're equal, I will still go for the bank because I know I can still get that money from the bank and let that money go be used elsewhere to make more money for me. I like to use my whole life policies to make me money, not just save me interest. That's the thing. Now, if you have car loans go up to like 8 or 9%, great. Then you might want to borrow from your policy instead because you might be able to get a few percentage points lower. Perfect. That's great. But again, I like to borrow any cheap money I can get from the bank when I can. Also, do not use this like a checking account. There's a lot of people say, oh, you just move money in and out and you put all your money in, put all your paycheck into this policy, and then you just pay all your bills with it. That's another popular thing that was taught when I first started learning about infinite banking. Totally bad idea, lots of work, makes you very little of net interest anyways, and really all it does is make the insurance agent more commissions. That's why they teach it. They're saying, hey, if I can just take all of your income and put it in, which is really hard to even justify anyways with an insurance company, it's just not a good thing. So just, like that whole using it as a checking account and moving money in and out, no, don't do it like that. I like it, keep it simple, less time and less attention is good for you, especially if you're trying to make more money in other places. Now, here's another warning too, is beware of counterfeits. There are a lot of people that talk about infinite banking, but they'll say, oh, but you won't use a whole life policy, use an indexed universal life policy. This is really just the same. It is not the same. They do not work the same. I know because I was actually poo-pooing. I used to hate on whole life back in the early 2000s, and I actually used to offer indexed universal life insurance policies to my clients before they got popular, before everybody started talking about them. And when I was offering those things, and especially when I trained other insurance agents about how they worked, the thing is I learned about them more and realized, oh, there's a lot of different differences here, and no, they can't do the same things. It's not the same. In fact, there's higher risk there. So beware of these counterfeit things of people just trying to sell you and spin it into that box. I actually taught somebody about infinite banking. There was an insurance agent, a financial advisor, taught him about that. And what did he do? Instead of offering it the way I showed him, he said, oh, I just fit it into my little box here with my indexed universal life policies. Counterfeit, false, doesn't work. Okay? All right, now here's what is true. Whole life insurance is safe. This is why banks put their money there. With minimum guarantees, some companies have a guarantee of at least 2, 3, sometimes 4% are the guarantees they'll have on these whole life policies, and that's like the minimum interest they'll pay you. Also, here's what's great, is that unlike the banks, who FDIC only has less than 2% of money sitting in reserves in case banks fail. Less than 2% of all your savings are actually protected. That's scary. So if there's a big bank failure happening beyond just the 3 that we heard about, that would wipe out everything in FDIC, and then where do you get the money from? How do you get your money paid back? Whole life insurance companies are different. One, they can't leverage money like a bank. They can't take the same risk that banks take. And then 2, whole life insurance companies have also what backs them up called reinsurance companies. Reinsurance companies are global insurance companies that backs them up in case they go under. So if an insurance company ever happens to fail, which is much more rare than banks, if they happen to fail, they cover your death benefit and your cash value. It's protected. So in my opinion, I believe whole life insurance is safer than the bank, and it pays a better return, and it's tax-free. Heck, that's why I have most of my money sitting in whole life versus sitting in the bank, for that very reason. All right, so is it too good to be true? Well, most cases are worse than the truth that you see out there today. You can actually do better. The thing I see is when I see people talk about infinite banking, they'll show numbers. I see those numbers and I say, that person's overcharging you. That person is actually charging you double what you should be paying. I see people say, oh, here's the 60-40 blend. Okay, well, great. Well, that 60%, 40%, that 40% is the cost to you. Well, what if that cost could be cut in half to 20% instead? Now, some people say, well, there's a 90-10, or I could get over 90% of my money in year 1. Yeah, but the years after that, they'll charge you more money so that you'll end up paying more than if you paid 20% in year 1 and things like that. So there's a lot of problem that I see is that even if you're seeing it, you think it's too good to be true. The funny thing is most of the cases on videos and things that you see out there today are actually worse than the truth or what you could be doing. So it could actually be better than what they are saying it could be. Now, like other than the half-truths I talked about before, really when you're looking at how well the numbers can do, they could do so much better than what you're seeing today, because either one, those insurance agents don't know how to do it, or two, they just don't want to cut their commissions back enough to do it that way. And so they kind of blend it and say, well, I'll cut it back this much so they can do that. That's why we call ours kind of like a no BS max ROI infinite banking, right? Our non-negotiable is you have to get the best, lowest cost every time so you get the maximum return possible. That's what max ROI means, max return on your investment, or in this case, max return on your savings that you're putting into this. And so just so you know, that when you say it's too good to be true, most of those cases are actually not as good as it should be. So know that it can actually be done better. You just have to find the right people to do it for you. And there's a very few people that do it that well. I will tell you that much. All right, guys, I hope this is valuable for you guys. Put comments below. Like, what are your thoughts here? What are some other half-truths maybe you've heard about that I might have missed? And by the way, if you want to keep going down this rabbit hole, check out this next video, Infinite Banking Concept Q&A that I did. Check it out.